first thing we need to do in making adjustments is to find some cash. There's several sources of cash, and the first one, probably the easiest one, is to set some money aside at the beginning of the month that you use for adjustments in case they're necessary. We recommend holding 10 or 15% of your total portfolio value in cash for such adjustments. Secondly, you can roll over some of the current month short options you've got till the next month and generate some cash. If the stock has fallen over the course of the month, that means that the options at the other end of the spectrum, the higher strike options, probably have very little decay left, and you might consider rolling them over to the next month. We use a concept called average daily decay to determine at what point you should roll over, buy back the current month options, and sell the same strike next month options. You do this by looking at the bid and ask price of the current month option. In this case, it's bid 10 cents, asked 15 cents. You divide the number of days into the ask price, because that's what you're going to have to pay to buy that option back, and determine that the average daily decay of the current month option is $1.50. Then you look at the next month option, and in this case it's it's a bid 70 cents, asked 80 cents. You divide, in this case, the number of remaining days, which is 38 days, into the bid price, because that's the price you would sell that next month option for, and you determine that the average daily decay of the next month option is $1.84. So over the course of the month, you'd be collecting more each day in decay by having your money in the next month option rather than the short one. Of course, when you roll over, buying at 15 cents, selling at 70 cents, you'll pick up $55 per spread, which you can then use for adjustments. The third alternative way to come up with cash is to sell a calendar spread that you already have in place at the other end of the spectrum. In this case, we're looking at what happens when the stock falls. So you would look at the highest strike calendar spread that you have on and liquidate that, sell it, and use that cash for an adjustment. Okay, so how do we make adjustments? The first and most logical way is to place a new calendar spread. In this risk profile graph, the downside break-even point is at $102 a share. That is a precise strike where we should place the calendar spread, because that calendar spread will make a maximum profit at that exact strike. It will have the effect of reducing the downside break-even point from $102 probably down to $100 if you buy the calendar spread at that lower break-even strike price. As an alternative to a new calendar spread, you might also put on a butterfly spread. In this case, we're going to protect against the downside movement of the stock. So we start the butterfly spread by buying one put. We typically use butterfly spreads, puts on the downside, calls on the upside. If we're trying to protect against a higher price, we use calls. If we're trying to protect against a lower stock price, we use puts. So we would buy, in this case, we would buy one current month 102 put. We'd like to go down $3 on our butterfly spreads, and so you would sell two 99 current month puts, and then you would buy one 96 current month put. You probably want to do this 5 or 10 times so that you have plenty of protection on the downside. Butterfly spreads are quite inexpensive. In this case, we're probably talking about $40 per spread. So that if you put 10 of them on, that would be $400, including commissions. And that would take up about half of the $1,000 we originally were hoping to make in this portfolio before the stock fell so much. So let's look what the risk profile graph looks like after we put on a butterfly spread. This butterfly spread certainly makes the graph look a little weird. If we hadn't put the butterfly spread on and used a calendar spread instead, this curve would have continued on over pretty much here. But with a butterfly spread, we get this big gap in here. Exactly at 102, we have a break-even situation. But if the stock should fall further than that, we start making more money. So if it falls down all the way down to 99, we would make $500, or about 5% for the month. I want to say one thing about this break-even spot. It really is not true, because on the very last day, if we are long a bunch of 102 puts and the stock is trading right exactly at that price, even with a few hours left in expiration day, we'll probably be able to sell that put for perhaps $40. And we had 10 of them here. That's $400. So that what shows here on the graph as a zero profit for the month may very well be a $300 or $400 profit. A third alternative adjustment would be to put on what we call an exotic butterfly spread. This costs a little bit more money, but it gives you a little bit extra protection. An exotic butterfly spread is when, instead of buying the 102 put for the current month, you'd go out a month or two, or you might even go out and buy a leap, because at the end of this month you may want to put a calendar spread on at that strike, so that you would leg into it by using the exotic butterfly spread to start with and then turn it into a calendar at the end of that month. So let's look at how we can summarize adjustments. First of all, you should start off with a good cash reserve so that you don't have to liquidate any of your current positions to make the first adjustment. Secondly, you should be slow to adjust. Wait until the stock has moved dangerously close to one of the break-even points. We have found that in most months, when the stock moves 5 or 6% in one direction, it's far more likely to reverse direction, at least for a few percentage points, than it is to continue in that same direction. I would recommend that you follow the Terry's Tips portfolios for the 2 months free service you get when you become an insider, so that you can see how we make adjustments in our 8 portfolios over time. That way you'll become much more familiar with how they go. Or even more easily, you can sign up for auto trade with Thinkorswim, our favorite broker, and they will make all the adjustment trades for you that we make in our portfolio. In order to auto trade, however, you really need to become an insider, and you should know what the insider benefits are. First of all, you get this great white paper, which 60 plus pages, which describes 2 very important option strategy in great detail. You also get 20 what we call lazy way companies. We call them lazy way because you make 2 investments, 2 trades at the beginning, and you sit back and do nothing for 2 years. And you are mathematically guaranteed a 100% gain over that 2-year period if the stock stays flat or goes up by any amount. In most cases, the stock can actually fall 10% and you still make the 100% gain. And also in most cases, the stock can fall as much as 25% before you lose any money. You get the list of 20 companies where this particular strategy works when you become an insider. You also get a 14-day option tutorial. Now, it won't make you an option guru all in itself, but will give you a good sound education on all sorts of option strategies and options terms. And finally, get 2 free months of our weekly newsletter where you can see how these 8 portfolios unfold over time. And each week, we come out with another options report of some sort pertaining to our strategies in general. You become a Terry's Tips insider at terrystips.com. Please come. Welcome aboard. It only costs less than $80. That's less than the cost of dinner for 2 at a decent restaurant, and you may very well increase the amount of money you're making in your portfolio by 5 to 10% per month. You're certainly not doing that with your mutual funds right now, but you might do it if you come to Terry's Tips. We look forward to having you on board.